Hey everyone, today's going to be a different kind of video than I normally do. It's a little past 10 p.m. on Friday, March 10th, 2023, a day that surely is going to live on in infamy. It's been without a doubt the craziest 24 hours of my professional life, and I suspect many others too. Silicon Valley Bank is the most important financial institution for the biggest innovation hub in the world. The fact that it's failed is, as YC President Gary Tan said, an extinction-level event for startups.
YC has funded about 3,000 active startups right now. I would guess that this affects more than 1,000 startups, and about a third of those startups will not be able to make payroll in the next 30 days in the current configuration.
There's going to be 1,000 videos made about this in the coming days, weeks, and months, but I'm just going to give a real-time narration of what the last day was like in the middle of this as a VC in Silicon Valley, and talk about where we go from here. So early yesterday, Thursday, March 9th, everyone in the Valley was shocked to see SVB stock price crashed 60%. What happened was SVB surprised everyone by announcing they saw a $1.8 billion loss on the fire sale of bonds, and that they were selling stock to raise more cash. It was terrible timing because crypto bank Silvergate Capital just went under at the same time. And those contagion fears even spread to Wall Street, which lost $55 billion in market value in a single day. So around 10 a.m. or so, I started hearing rumors that some of the big funds were advising their portfolio to get out of SVB as fast as possible. That includes some of the giants in the industry, like Founders Fund, Sequoia, Union Square, YC, Iconic, just to name a few. I don't name them to shame them necessarily, except to say that these are the folks who funded the biggest startups that control billions of cash sitting at SVB. And you have to pay attention when that amount of money is heading out the door. And right around that time, Silicon Valley was splitting into two factions. There were those who recognized that the only thing we have to fear is fear itself, right? If we all just chilled out, things are going to be fine. So these folks were saying, sit tight, we can all just get through this together, which was true. But then there were another set of folks who realized that if you're a startup, there's no downside to moving your money out of SVB. And if there's a 1% chance that SVB goes under, you have to do it to protect yourself and your shareholders as a fiduciary. Silicon Valley was in this massive prisoner's dilemma. And if you're hearing everyone is already breaking out of prison, you can't be the last one to just sit there and rot. And so what we had was this classic bank run where beliefs become self-fulfilling prophecies. And in that context, it's not about fundamentals. SVB itself, while yes, they were extending a lot of risky loans and were getting crushed by rising interest rates, they would have been just fine without this. But any bank will go under if everyone asks for their money at the same time. So some of the first VCs that saw this coming started pinging their founders in the morning on Thursday to tell them to get out of SVB. And naturally, SVB started to get overwhelmed with calls, and the site went down and it was impossible to get through to speak with anyone on the phone. And even if you could get through to SVB, there was another problem. A lot of startups don't even have a secondary bank account they can wire money into. So at the same time, there was this mad dash to open up secondary accounts at First Republic or JP Morgan. But the problem is that takes several days to set up. So founders were left trying to open these Mercury or Brex accounts same day. There are rumors, by the way, that some of Brex's investors who stood to gain the most were among the first to encourage their companies to stampede out of SVB. If so, that's a crazy side story that we're going to hear a lot more about in the future. But anyways, Mercury and Brex were getting so much volume that they were getting overwhelmed and going offline at certain moments too. And so in this chaos, founders were even sending money to their own personal bank accounts, which has a lot of risks. And some founders even resorted to going down physically to an SVB branch and taking out millions of dollars in a cashier's check. There are stories about lines out the door at adjacent banks with these founders holding millions of dollars in their hands. It's crazy to think about, but if these founders had lost that check or got held up at gunpoint, their companies would have just gone under right then and there. And so you can imagine during that period, as a VC, I've got 25 frantic text threads with founders who are trying to figure out, first, how real is this? And then once they realized it was an existential crisis, working through all of their options real time. Now, around 1 p.m., we as venture capitalists called an emergency meeting at my fund to make sense of all of this and try to share advice to our founders in a more programmatic and thoughtful way. By about 2 p.m., things were starting to get ugly. Outgoing wires from SVB were frozen. And that's when all the rest of the founders and VCs were starting to wake up to what was happening. But by 3 or 4 p.m., it was just too late to try to do anything anymore. Founders at that point were just wiring and hoping that it would clear in the morning and they'd be safe then. All told, by the end of Thursday, startups and companies tried to take out $42 billion from SVB. But things got even crazier today, Friday. This morning, we all woke up to the unbelievable news that SVB failed and was being taken over by the FDIC. So now companies had their assets frozen at SVB indefinitely and were being forced into emergency planning mode. And again, I'm getting these panic text messages from founders, and our firm decided to hold another emergency meeting on what to do about this. And I have to say, before what comes next, I'm not a financial advisor or lawyer. If you're a founder, you have to do your own research. But here's what a lot of founders were doing. The first was figuring out their exact exposure to SVB and their liquidity. A lot of founders have a little bit of credit elsewhere, like in Brex, or cash on hand in a different bank. Some founders have managed to move their SVB money from an on-balance sheet account like checkings or savings to an off-balance sheet one that's actually custodied by a different bank. In that case, while it may take a while to transfer their money, they should still be guaranteed to be made whole. So there's a bit of this accounting exercise to figure out what money is actually available when to make payroll. Part of this is the FDIC's $250,000 insurance, which is theoretically being distributed Monday, March 13th, but is not enough to complete payroll for many companies. So many companies are looking to collect on their accounts receivable as quickly as possible to get cash in the door, and to make sure that any inflow of cash is not flowing into SVB accounts. And frankly, to make ends meet, a lot of companies are having to go supplier by supplier and categorize which of them are must-have vendors that they'll keep paying, and which are vendors they're going to have to defer payments. A lot of these suppliers will agree to delay payments, as will creditors potentially if you have to make interest payments. And then thereafter, companies are creating daily cash flow reports to continue monitoring closely. It's a desperate dash to make payroll because not doing so incurs all sorts of company risk, from employees' suits to employees just leaving. But if absolutely necessary, companies can take the hard step of communicating in advance and furloughing employees to defer salary. On the board level, there's tons of contingency planning right now on different scenarios if the $250K doesn't come right away, or certain dollars are not accessible as early as planned. And lastly, as a backstop, companies are speaking with their investors to figure out plans for bridge financings in the case that everything falls through. But you have to remember that if half of all startups have their assets frozen on SVB, half of all VCs do too. And if assets stay frozen for a long time, there's only so much companies can do, and the coming weeks and months are going to be a bloodbath. If there's one silver lining, though, it's that this catastrophe is so widespread that it has to incur the focused effort of the government and the FDIC to make things right. We are, after all, talking about hundreds of thousands of people's livelihoods here, and the risk of contagion. There were rumors already flying around that other banks might be next. Now, this is a fluid live situation, and at the moment I'm speaking on Friday, no one really knows what's going to happen. But I'm going to pass along a few pieces of uncorroborated intel floating around the valley right now that would give some reason for hope. Supposedly, the Senate Banking Committee is pressuring the White House to find and acquire for the assets of SVB by Sunday and make account holders as whole as possible. That would be best case scenario because, as mentioned, the longer this drags out, the more companies are going to go bankrupt. Word on the street is that Morgan Stanley is in the West Wing, and some have guessed that Wells Fargo might be in the running as well. Again, none of that is confirmed. This is all hearsay, and it's possible that when this video actually comes out, you might actually know more than me. But in any case, I think the prospects of finding a buyer for SVB is a good one because the asset is worth a lot. A lot of SVB's balance sheet is government-backed securities, which could be liquidated pretty quickly and recover a large portion of deposits. SVB has roughly $165 billion of deposits, and some estimate that the combination of cash, securities, and loan sales could generate $180 billion, which would be more than enough to cover deposits. And perhaps maybe even half of that could be seen as early as next week. In that rosy case, SVB's losses would be limited to just equity and bond holders and not depositors. Now, if a company is expecting a future loan from the bank, I think it's safe to assume that's unlikely. But nonetheless, there is some promise here. And it's just as well, because for founders and employees, startups are already hard enough. If that's you, I hope this video has been some help. And for the rest, I hope that the video is some insight into the unprecedented challenge startups are going through right now, and a call to action for the government and regulators to get this right. Thank you for watching, and good luck.